So in this video, I want to walk us through an example that uses the cost classifications that we went over in the PowerPoint introduction. This is actually the first review problem that is located in Chapter 1 in your textbook. And what we have here is a company that manufactures furniture, including tables. And so we're looking at some of the different costs that this company incurs, and we want to classify those costs in a number of different ways. First of all, we want to classify them as variable or fixed. In other words, how will these costs change based on the change in activity? Then we're going to classify them as period or product. Are they tied to the product, in this case, tables, or are they tied to the period in which they are incurred? Then within that, if they're period, we need to identify, are they tied to the selling of the product, or are they just purely administrative costs? And if they're product costs, are they direct materials, direct labor, or manufacturing overhead? Note that period costs and product costs are mutually exclusive. Selling and admin are mutually exclusive. And direct materials, direct labor, and manufacturing overhead are mutually exclusive. However, we will be able to classify costs as variable or fixed and period or product. And then lastly, we want to look at whether or not these costs are relevant to decision making. And so we want to identify whether we have a sunk cost or an opportunity cost. So let's start with the first one. The first one says, these tables are made of wood that costs $100 per table. So based on behavior, if the number of tables we manufacture change, will the total cost of wood change? And I think the answer is yes. We will need more wood if we manufacture more tables. So this would be a variable cost. Now, is this tied to the product or is it tied to the period in which it's incurred? Again, I think it's clear it is a product cost. It is the material that goes into the product, so it is direct materials. Number 2, the tables are assembled by workers at a wage cost of $40 per table. The first question, will the total wages go up or down if our manufacture of tables goes up or down? And I think the answer is clearly yes. So this is a variable cost. The more tables we produce, the more wages we will have to pay for that production. Is this tied to the product or is it a period? Well, it's the cost of manufacturing the product, so I think it's clearly tied to the product, and this would be direct labor. Now, I've said a couple of times clearly. Let me hasten to add that in these two cases, I think we have clear-cut examples. That workers assembling the tables are supervised by a factory supervisor who is paid $38,000 per year. Well, will that change, that total change, if we manufacture more tables? And the answer is no, remembering that relevant range, that if the factory supervisor oversees up to X number of tables, maybe 10,000 tables, I don't know. If we increase production beyond that point, we might have to add another factory supervisor. But always remember, we're evaluating this in light of the idea that we are staying within the relevant range. So this cost would be a fixed cost because If we manufacture 100 or 10,000, it's still going to be $38,000, but it is related to the cost of the tables. It is a product cost, but it can't be traced directly to the table, the individual table. So this would be an indirect cost and be put into manufacturing overhead. The fourth cost, electrical costs, are $2 per machine hour. 4 machine hours are required to produce a table. So the question becomes, the more tables we produce, will we spend more on electricity in total? And I think the answer is yes. So this would constitute a variable cost. Again, this is the electricity related to running the machines that are producing the tables, so it is a product cost. Can't necessarily be tied directly to a particular table, so we would accumulate this in manufacturing overhead. The fifth cost is the depreciation on those machines that were used to make the tables. And notice it's totaling $10,000 per year. Think back to depreciation methods. What this tells us is the company is using straight line because it's the same amount each year, which means it's going to be $10,000 whether we produce 10 tables or 1,000 tables. That makes it a fixed cost. Again, it is related to the manufacturing process, but it cannot be tied directly to the product, so it would go into manufacturing overhead. Now, you will notice that I have an X in sunk cost. This would actually be a sunk cost. Remember, depreciation is the allocation of the original cost of an asset. These machines have already been acquired. If we were to decide tomorrow to quit producing tables and therefore we don't use the machines, we've still spent the original cost of the machines. That's a sunk cost. If we were trying to decide whether to continue manufacturing or not continue manufacturing the tables, the original cost and therefore the depreciation would not be relevant. Now, if we were deciding on that and we were talking about, well, if we quit using the machines, we could sell them for $4,000. That's a different ballgame. That resale price would indeed be a relevant cost. Okay, the sixth cost is the salary of the president of the company, which is $100,000 per year. Notice I have that under fixed. His or her salary is not going to change if we increase or decrease production, at least not tied directly to the number of tables we produce. That constitutes a fixed cost. Notice I also have it under period and under administrative. The cost of the president is not a manufacturing cost. It is part of the cost of administration of the company. Number 7, we spend $250,000 per year to advertise our product. That is going to be a fixed cost. It's $250,000 irrespective of whether we produce 1,000 tables or 100,000 tables. We're paying for a service, which is the advertising. Notice it's also under period, but it's under selling. The advertising for our product is a direct cost of selling. Number 8, salespersons are paid a commission of $30 for each table sold. Notice I've put that under variable cost. The more tables we sell, the more commissions we will end up paying. However, it is also a period cost, specifically a selling cost. Again, keep in mind, variable and fixed can apply to period or product. But the commissions are related to the selling, not the manufacture, and therefore they are a period cost. Last cost, the company could rent our factory space for $50,000 per year if indeed we were not producing tables. That is what we call an opportunity cost. By choosing to produce or manufacture these tables, we are effectively giving up $50,000 in rent, and that becomes an opportunity cost.